Welcome to Lesson 2. Today I'm going to talk to you about taxes. I know taxes are not everybody's favorite subject, but if we are to become better investors, we need to be tax focused. But a lot of times people will say, I know taxes are important, but come on, what's the big deal with taxes? I'm going to show you. So let's imagine we have this mythical investment, and this investment doubles every single year. So at the end of the first year, it's $2, and then $4, and then $8, and $16, and $32, and this goes on for 20 years. So how much do you think this account would be worth at the end of 20 years? Most people say $15,000, maybe $20,000. I heard someone once say $50,000. So that's a lot since you only started with $1. But the answer might actually surprise you. The answer is that account would end up with over $1 million. So the takeaway is to find this investment and invest in it. No, that's not the takeaway. Our focus is on taxes. So let's see what would happen if we added a fairly nominal 30% tax. So if you look at federal tax rates or state tax rates or capital gains rates, 30% tax is not that high. So again, let's say we found this investment that doubled every single year, but we had a 30% tax each year on that growth. So what do you think this account would be worth now at the end of 20 years? So most people will figure, well, it was $1 million without a tax, and then there's a 30% tax on it, so maybe $700,000. And they would be wrong. It's actually not $700,000. Turns out with the 30% tax, instead of $1 million, it drops down to $400,000 with just a 30% tax. So this is the power of taxes. Without a tax, over $1 million. With a 30% tax, it's Oh, you know what? I think I made a mistake. You don't end up with $400,000. Actually end up with $40,000. This is the example that the professor of mathematics did not believe with his own eyes. I had to open an Excel spreadsheet and run through the numbers with him, and he still was flabbergasted. So let's look at this. Without any tax, this portfolio would be worth $1 million, almost $50,000. And with a 30% tax, not that high, 30%, that account gets chopped and cut down to just $40,000. This is the power of taxes. My whole goal for you is to help you build, create, and sustain wealth. That's hard to do when we have taxes to deal with, because this is the dramatic impact of just a 30% tax on a portfolio. But now let's look at more of a real-world example. So here you'll see an investment over 30 years. Start off with $100,000, and at the end of 30 years, you can see if there were no taxes, this would be worth almost $800,000. With tax, about $400,000. Now think about the difference in your retirement between an account with $400,000 and an account with $800,000. It's night and day difference. It could be the difference between having a great retirement where you can afford to do the things that you want to do and one where you're just scraping by. This is why, as investors, we need to be tax focused. You know, I'll even go so far as to say, not just tax focused, we need to be tax obsessed. We need to be looking at each transaction and focused on how can I cut my taxes as an investor. So the question is, how do we do that? What's the solution? Let's run through a few different strategies you can start to think about as an investor. The first is to focus on low turnover ratio in the investments that you have. So what's a turnover ratio? Well, imagine this. You have a mutual fund that you invest in. And on January 1st, this mutual fund manager has a basket of, let's just say, stocks that he manages. And on December 31st, if he had the same basket of stocks, he didn't do any buying or selling, then the turnover ratio would be 0, meaning 0% of his investments were either bought or sold. He didn't do anything that year, so it's a 0%. Now imagine another mutual fund manager. She has a turnover ratio of 100. What that 100 means is that means 100% of her holdings were either bought or sold during the year. And here's the scary part, that this turnover ratio, it's not just 0 to 100. I've seen turnover ratios as high as 1900%. So what that means is that the manager is literally buying and selling every single trading day. Throughout the day, they're buying and selling. So what does this have to do with taxes? And what does this have to do with us as investors? Well, the IRS taxes our investments a little differently, depending on if they're short-term gains or long-term gains. So a short-term gain is anything that's a year or less. So what happens if you have a portfolio and a manager that's buying and selling throughout the year? There may be a lot of short-term gains. Those gains are taxed at our ordinary income tax rates, versus a manager with very low turnover ratio who holds those investments longer than a year. Those are taxed at capital gains rates. The difference can be 20% or more. So look at your investments. Look at the funds that you have. See what the turnover ratio is. Next, consider replacing some of your mutual funds with ETFs. Well, what's an ETF? ETF stands for Exchange Traded Fund. Both mutual funds and ETFs think of them as baskets of holdings, baskets of securities. These securities can be stocks, they can be bonds, they can be all kinds of different things. The basket itself is the mutual fund or the ETF. It just holds investments. But here's where things get interesting. Mutual funds often pass along their capital gain distributions each year, usually at the end of the year. So even if you're new to the fund, let's say you bought a fund in August, what can happen is that fund may have embedded gains, meaning gains that they've held on to for a few years, and those can get pushed down to you, even though you're a new investor. And because those gains get pushed down to you, you can be taxed on those gains. And what's even worse is when you have lost money in a particular fund for a given year, but because that fund had embedded gains in it from previous years, not only could you have lost money in a particular year, but you can also get hit with a capital gain distribution from that fund. So that's a true double whammy, something you want to avoid. So exchange traded funds can be more tax efficient. Oftentimes, you don't get the same level of capital gain distributions pushed down to the shareholders. So consider looking at the mutual funds that you own, looking at the capital gain distributions that they've pushed down on you every single year, and see if you would be better off in an exchange traded fund. Another idea to help you become more tax obsessed is to take advantage of asset location. You're probably familiar with asset allocation, which is spreading your investments into different categories. But asset location is something a little different. Asset location takes advantage of the fact that certain accounts that you might have might be taxed differently. So for example, let's say you have a 401k. In a 401k, every year you're not taxed on capital gains or any income that's produced. That's a tax deferred kind of an account. If you have a Roth IRA, not only is it tax deferred, meaning you're not paying tax each year, but it's tax-free forever, because when you take that money out, you're not even taxed on it. Compare that to an individual taxable account, like maybe a living trust account that you might have. Well, in a living trust or taxable account, any income that's generated, any capital gains that are distributed, that's taxable to you for that year. So if you have very tax inefficient investments, maybe you have a fund that you really like, but it has a really high turnover ratio, instead of putting that in your taxable account, where you're going to be taxed on that year after year after year, consider putting that in a tax deferred account, maybe an IRA or a 401k. Speaking of Roth IRAs, consider maximizing your Roth IRA contribution. Now, Roth IRAs are unique in that although you don't get a tax deduction when you put money in, what happens is you're never taxed on any growth, any income, or even any distributions from that Roth IRA if you meet certain guidelines. But for most people, they can put money into a Roth IRA and they're not taxed on any growth or any income. So that's why I love Roth IRAs. They are the most tax efficient vehicle you can have. So you want to make sure that you've got some funds in a Roth IRA and that you put money into a Roth IRA if you qualify. So the IRS doesn't let just anyone contribute to a Roth IRA though. You have to meet certain income requirements. If you make too much, they don't allow you to invest in a Roth IRA. But there are various strategies on how to still invest in a Roth IRA that you should consider. And I'll talk about these strategies in a potential new course and a new video down the road. Also, consider utilizing qualified dividends. So dividends are taxed differently than a qualified dividend. The IRS has favorable tax treatment for qualified dividends. And so look at your portfolio, look at your investments, see what the split is between qualified dividends that you receive versus non-qualified dividends. And if you're in a high income tax bracket, again, consider focusing on qualified dividends to reduce your tax bill. Also, consider tax-free income with municipal bonds. So municipal bonds are unique and can be quite advantageous for investors. A municipal bond is a bond that is issued by a city or municipality. And what makes them unique is that the income that you receive from that bond is federal income tax free. And here's the kicker. If you buy a municipal bond from the state in which you reside, then it's also state income tax free. So here's an example. Let's say you live in California. If you buy a California municipal bond, all that income that you receive in a given year from that bond, you don't have to pay any federal tax on it, and you don't have to pay any California tax on it. So if you're in a high income tax bracket, federally and in California, municipal bonds should be something that you consider because they can produce tax-free income directly to you. Coming up next, so you're probably familiar with asset allocation, but in the next lesson, I'm going to tell you why asset allocation is for losers. And I'll tell you a story about a new client who used several four-letter words after I analyzed her portfolio and gave her the results. You're going to find out why she was so upset in the next lesson.